likely heard from many different sources that in order to retire semi-comfortably, at least, you should be shooting for $1 million in retirement. Now, whether that is accurate or not, I am not here to debate. I think it all depends on your lifestyle and what you're likely to accomplish. However, if this is your goal, if $1 million in retirement is your goal, and you are wanting to find different thinkings and different strategies about how do we reach that, you are in the right place. In today's video, we are going to assume a few different things. We're going to assume that you are a business owner earning $90,000 of income and you're filing single for the tax purposes. We're going to make it even more interesting. We're going to make you pay for your student loans because vast majority of clients that I have that are business owners are highly educated, and that means they have student loans. We're also going to assume that you need healthcare insurance, and let's assume that you need to go through a marketplace shopping for one, and why not? It's open season, as I like to call it. Open enrollment, but I prefer to call it open season. And of course, we're going to be figuring out how to save for retirement. Welcome to Elephant Corner Financial Lab. Let's get started. So, what did we assume? $90,000. We're going to shoot for 1 million. And in the process, we're going to attempt to do a few different things. We're going to attempt to lower your taxes. We're going to lower the healthcare premium, lower the debt repayment, because if you're going to go for student loan forgiveness, you might as well get forgiven as much as you possibly can and make the smallest payments you legally, ethically possibly can. And of course, we want to reach that or increase that retirement savings. I'm also going to assume a few other things. I'm going to assume, because I'm located in the state of Vermont, and I'm going to assume that that's where you are. Now, one of the cool pieces here is that it is going to increase some of the taxes because of the state taxation. If you are in a state that has lower taxes, it might be lower. If you're a state with higher, it might be higher. But roughly speaking, I think this is going to explain a lot of things. So let's get started. Okay, let's assume, right? So scenario number one, we have that $90,000, right? And let's assume that you met with some sort of financial professional, watched the video, figured it out on your own, read a lot of books. However, but you have figured out that you can take a W-2 as in salary, and let's say you said $82,000 sounded right. And then let's assume that you basically do a profit share out of your business that is $8,000. Okay, this is a fairly typical setup that I see from the business owners that I work with, and they like having this little bit higher salary that they can show to their friends and they can boast, and it feels good, right? It feels good being highly educated to say, I am also earning a nice chunk of change. Let's take a look at what happens here. Now, we have a few things to solve for, right? So we're going to do a nice little line, okay? And we're going to have a tax, right? Let's find out what the tax is in this case scenario. We're going to look for a health plan. Let's assume that the student loan is going to be IBR. So what happens in the first case scenario? What are the costs? What are the expenses? Well, if we have this set up right here, what $82,000 comes out of W-2 and the rest of it is profit, at $90,000, all of the taxes, that includes federal, state of Vermont to be specific, and FICA. In this case scenario, you are looking at just over $20,000. A lot of these things are based off of AGI, adjusted gross income. A lot of things that are calculated on how are we, what benefits we're able to do to take, or what we're able to do comes out of the either modified adjusted gross income or just plain old adjusted gross income. So I think it's important that we also add another column over here. So here we go, AGI, because I think it's important that we have that. And in this case scenario, our AGI is going to be 88,427. I've already pre-calculated this so that I don't have to run calculations while we're chatting about what happens. Now, because the healthcare plan and student loans are driven off of the AGI, so AGI drives this, here is what you can expect for the lowest cost health plan. It's going to be bronze for a single individual in state of Vermont. You are looking at $824 per month that you're going to need to spend for your health plan. And you're looking at $823 in payments towards the student loans. Second case scenario, let's say it's the same $90,000, but now we've done a little bit of a strategy and we're going to assume that you're going to take $60,000 out of W-2, okay? And out of the profit, we're going to take $30,000. So still same $90,000, but a bit optimized because maybe you met with a tax professional who evaluated and said, you know what, we can do this legally, ethically, and without triggering an audit. Now, what does the tax look like if we were to go with this method? And the tax in this case scenario is just actually a dollar shy off of $18,000. So we're saving a little bit over $2,000 in this case scenario. What does the AGI look like? Oh, AGI remains unchanged. Okay. And hopefully we're learning something over here because the health plan on the marketplace as well as the student loans are based off of the AGI. It remains unchanged. You're still paying $824 for the health plan and $823 per month on your student loans. Now, hopefully you're noticing something very interesting here. We're figuring out our income, reducing our taxes, figuring out how to pay for health plan, how to pay for student loans, but we're not quite saving for retirement yet. Now, I wish I could tell you as a financial planner that a lot of my business owners already have a retirement plan figured out before they come to me and start working with me, but that's simply not the truth. Vast majority of business owners plan to sell the business maybe, or haven't even thought that far. But you're here, you're watching this, you're a smart business owner, and you said, I do need to have a retirement plan. So let's create a retirement plan. Let's create a third scenario in which you are a smart business owner and you have your $90,000 a year that is coming in, but you figured out this thing called simple IRA, and you decide you're going to put $1,000 a month or $12,000 a year. Now, in this case scenario, because we had $60,000, right? So we're improving every iteration of this. We're improving how we're thinking about our money. Our 60,000 of W-2 is now going to be 48 because we are taking out the $12,000 out of it. We are still taking our profit, but let's assume, because if you're starting a simple, let's assume that it's a 3% match, right? And you have some employees and maybe there's some additional costs. So let's assume that you, instead of 30,000, you take $25,000 a year. Okay. Altogether, we are looking now at $73,000 per year. That's your new income. Now, question comes in of what happens. Now, you might be wondering, like, wait, why am I making less? So let's remember, why we're making less is because we are going from this 60,000, right? So 60 and 30. This is going to be reduced because there's some cost. Maybe we're contributing to other employees within our business. And this is going to be reduced because we are now contributing to our retirement plan. The question now comes in is, what does our AGI look like? And AGI has actually dropped to $70,640 per year. This is good. This is good because we're looking to lower our health plan coverage costs as well as student loan costs. Okay. What do our taxes look like? And again, assuming federal FICA as well as state of Vermont tax, now we're looking at just a bit over $13,000. So we've done a good job. We went from $20,000 down to $13,000 in tax. We've also reduced our AGI. However, it remains unchanged for the purposes of a healthcare plan. It's still $824 because we didn't reach the threshold at which point the subsidies are starting to kick in. The good news, however, is that we did reduce our IBR to $601. So we did make a reduction here a tad, but I believe we can do better. So let's do better than this. In case number 4, we're going to assume that the simple still remains at $12,000, but we're going to also assume that we're going to get a healthcare plan because we're getting the lowest cost. That's going to be bronze. And prior to the new bill that was signed on July 4th, 2025, it had to be high deductible. Now, any bronze plan will qualify for HSA or health savings account, which is lovely. HSAs are great because they help us lower AGI, and we're going to assume that we're going to max that. As a single person, you can contribute maximum of $4,300 for 2025. It goes up slightly for 2026, but we're going to assume that we're in 2025. We're also going to assume one more thing. We're going to create another retirement account, individual retirement account, IRA, and we're going to max that out as well. I understand that if you are a astute viewer, and I believe you are, you're probably going to sit there and go, wait a minute, why am I opening an IRA when I have a simple? You don't have to. You can max out your simple, and if you have extra money to then put into the IRA, great. But if you just want to max out the simple, that's fine too. The only reason I'm doing that over here is I'm trying to layer things on and give you different options and different ways to play around with it. Because again, if you have different accounts, now we can talk different ways to invest and different options and so on. So that's the only reason why I'm doing that. If you want to just go into with the simple, that's fine. You can absolutely do that. All right. So now that we've answered that question, $1,000,000 question, let's take a look at what does this actually do to our income, to our taxes, to our costs, to our payments. So in this case scenario, now after all of this, your actual earning is going to be $61,700. Now, when it comes to AGI, something magical just happened. Your AGI dropped to $59,340. That goes over here. Let's continue this just so that we know what we're dealing with. All right. And remember, this is going to be the tax. This is going to be the health plan. And this is going to be the student loan IBR. And this is AGI. As we scroll down some, I want to make sure that you're able to see this. So if we were to do this, okay, let's make sure you can see this nicely. This is what it looks like. So our AGI dropped quite a bit, which is lovely because it does something magic now to the health plan. But first, let's take a look at our tax. Our tax in this case scenario is just a shy of $11,000. Love that, right? So we've again reduced what we're paying in taxes. Where we really see the reduction now, and again, assuming that we assume, is that your health plan coverage on a monthly basis dropped by $800 a month, y'all. So now we're looking same coverage, same plan, same you, but now it's costing $22 a month as opposed to $824,000. Sorry, not thousand. Jeez, that would be very expensive. Sometimes it feels that way, doesn't it? $824 a month. Now, another piece that this impacts is the IBR. And if we were to go off of the AGI, the IBR would be $459. Now, this is pretty darn good. We went from 823 down to 459 for the student loans, went from 824 down to $22. We went from 20,000 in tax down to 11,000 in tax, but I know I can do better. And the reason I know I can do better is because, well, there's the math, the science, the law, and the rules that support me. And here is the one cool piece. When it comes to the student loan repayment, in this case scenario, we're not going to go off of AGI. We're going to go off of income and alternate documentation. And again, if you have a planner that understands how student loans work and repayments work, they'll be able to spend time and explain this to you. So In this case scenario, it's actually going to drop to $318 per month. So here we go. We were able to save roughly $10,000 in taxes, roughly $800 in healthcare premium costs, and roughly $500 in our student loan repayment. All of this was possible by strategically positioning things and thinking through. Here is the other piece that is very cool. If we kind of zoom out, right? Let's zoom out and move things around. Let's take a look at the retirement component. In the first two cases, our retirement was zero. There is zero saved for retirement whatsoever. Nothing being saved in for retirement. If we then move down to the third plan, we were saving $12,000 per year, which is pretty darn good. If we then looked at the option number 4, we are saving $23,300 per year. Pretty darn cool. On top of that, obviously, we reduce taxes, we reduce the cost, we reduce the payments. Now, one of the things to think through is if we're looking at this $23,000 that you're saving every single year, if you were to do that for, say, 10 years, okay, you would have a cool $233,000 in your account. And that is assuming zero investments, zero savings, zero returns, zero anything, zero change in how much you're contributing, right? So your income didn't go up, nothing changed. We're just putting the same amount year after year after year after year. But you are a very smart individual and you say, well, if I'm going to put all of this, I'm going to do all this work, that I'm at least going to invest some of that stuff in it. So let's make some assumptions as well. Let's assume that you're able to invest this and get a 6% per year return. Now, at the end of 10 years, doesn't change a whole lot, but we are looking at just over a third of $1 million saved up. So we're like almost there, right? We have 2/3 ready to go. Now, again, depending on where you are, how long you have to retirement, I'm going to assume one more thing over here. I'm going to assume that we are going to be doing this for 25 years. And the reason I'm assuming for 25 years is because it also allows for something very interesting to happen. Under the IBR rules, income-based repayment, which is the only old payment that survived the current administration, 25 years under the old IBR rules is when the whatever's left of the student loans is completely forgiven. So we're going to assume that you're going to retire when the student loans are forgiven, and you've been doing this for cool 25 years, doing the same $23,300 being contributed, assuming 6% return. At the end of that, you are looking at your nest egg of $1.28 million. Okay, this is how we go from 90,000 to $1 million in a few cool years where you can do this. Now, I believe that you can do this, and I also fully understand that not everybody has 25 years. Not everybody has the same exact thing. So, goal here was to get you to think a little bit differently as a business owner of how you're taking your income, and then what are you doing strategically to lower that AGI, to lower the taxes, and to actually start saving towards retirement. I hope you have enjoyed the video. I hope you have learned something. Make sure you like, subscribe, tell everybody else. And if you need assistance with your own financial plan, then feel free to reach out. Until next time, stay money blessed.